Welcome back, you legends. I'm Dr. Ken. Let's get right into this video. This is going to probably be the most important video I have ever made. So let's get right into it. The S&P 500 today, guys, is flat. Nasdaq's flat. Dow is flat. Let's take a look at the stock market map and notably look at this, guys. Pepsi in the green following that beautiful beat by the company. PepsiCo defies fears of consumer slowdown with strong earnings and forecast. The company reported robust quarterly earnings on Wednesday and raised its forecast for sales and profit this year. Unfortunately, it's not all good news. Look at this, everybody. Our brands are being stretched to higher price points and consumers are following. So what's been happening really is that Pepsi has been digesting the higher input costs and passing those on to the consumer at a higher margin. Now, this did not happen last quarter. What happened last quarter was the opposite. A lot of consumer staples companies had to absorb the higher costs from inflation and reduce their profit margins to maintain market share. Now we're seeing the opposite happen, where the companies are passing on most of those costs and tacking on even higher prices to rake in higher profits. This usually, guys, does not happen unless the economy is really strong and jobs are really super strong. And that's what we got just a few days ago when we got that unemployment report coming in at 3.5%, the lowest we've seen since the pandemic. Now let's take a look at the different sectors, everybody. Defensive, cyclicals, and energy in the green. The rest are somewhere in the middle. And then we have utilities, real estate, industrials, and basic materials lagging. Utilities are getting hit really hard. They've sold off massively. We're seeing capitulation in utilities, similar to what we've seen with energy in June when we saw energy stocks capitulate in June, selling off nearly 20% in a single month. We're seeing somewhat of the same story here, but notice this, guys. We're now hitting major support areas. And a weakness in utilities is emblematic of an end stage sell-off. They come first for the weaker companies, and then the last to fall are the generals, the defensives, the utilities. And I'll get more into that just in a second. Now let's jump into the daily chart for the S&P 500. Again, we're grinding down. We've made a new closing low today, taking out the September low that we had back on September 30th. Just barely taking that out by $0.50. And so we're seeing weakness, indecision, indecisiveness, fear ahead of the CPI reading tomorrow. And that's good news. We don't want to see the market being bullish and optimistic ahead of CPI because the last time that happened was a disaster. We want to see the market going into this event with maximum fear so that the slightest beat, the slightest hint of optimism can send us roaring back to the upside. We are now, everybody, forming a bottom on the S&P 500. We are finally forming a bottom for the year on the S&P 500 this month in October. This is it, everybody. This is the final crash. We are now entering the last stage of this sell-off for 2022. There will be more pain next year, but for this year, this will be the final crash that I've been talking about. And let me jump into seasonality to explain what I'm on about. We are right now, everybody, in the relief rally stage. In the first 2/3 of October, this tends to be a seasonally strong time. And then the last third of October tends to be the weakest time in the year, where I expect that final crash, that final capitulation bottom for the year to come in, either making a new low, sending us all the way down to 3,300, or making a higher low. That's going to depend entirely on company earnings. The last week of October, we'll see a lot of earnings come out, including big companies like Apple. And so whether we make a new low, we simply retest the September-October low, or make higher low is going to depend entirely on earnings. And that, legends, is going to be the final crash this year, in my humble opinion. And I'm going to go through a lot of data that says just that. Now let's take a look again at the weekly chart for the SPX, the S&P 500 index, and look at this, everybody. This is the 50% retracement level going back from the 2020 pandemic lows all the way up to the top in early January. And look at this, everybody. We are so close, so close to tagging that 50% retracement level. We are now sitting on top of this 200 weekly moving average. We have the 50% retracement level setting in really close. We are now 1% away from tagging that 50% retracement level, and very likely, everybody, that's going to happen very soon, potentially even tomorrow on that CPI print that's going to be coming out at 8:30 a.m. Eastern time. And so we have the 200 weekly moving average and the 50% retracement level. And at this point, everybody, I suspect and I know that a lot of bulls will be piling in, buying the market at these levels. And we have a lot of hints that suggest just that. Let's take a look at the HYG, the smart money up top, and the dumb money down below, the S&P 500. And look at this, everybody. We are again forming a bullish divergence. The last time we had that, we had this pop to the upside in the S&P 500. The prior time we had that was back here in the June low. We had this beautiful rally developing, a new uptrend developing right after that low. And we are now, everybody, in a very important zone. We have a double bottom with a higher low on the PPO on both the smart money and the S&P 500. We are extremely close to that 200 weekly moving average. We're sitting right on top of it. And then we have the 50% retracement level sitting at $352.50, just 1% away. We could easily tag that tomorrow and then begin a bounce to the upside, fueling a powerful, a face-ripping relief rally all the way into the last third of October, where we will start to see earnings come out, a lot of company earnings. And at that point, we'll see the final crash, either making a new low or testing the prior low, or simply making a higher low and establishing a new uptrend. So we have the 50% retracement level, we have the 200 weekly moving average, we have a double bottom right here with bullish divergence on the PPO. Now again, guys, I've been following this divergence for a while, and I've been sharing my technical analysis in the Discord trading group. A lot of people have been asking me what it looks like. This is what it looks like. Up top are the Money Time Machine rooms, a welcome page, announcement, trading resources. I post a lot of market research as well as stock and options teaching material, videos. I post member exclusive videos here, my weekly watch list, my investment ideas, my trade ideas and technical analysis. And again, my real-time trades. I post every single buy and sell in real time in this channel. Down below, guys, is the member section. There's a lot of rooms here where our legendary members, of which we have over 500, and we are growing rapidly. We have a new section, trade ideas, investment ideas, Forex. We have futures channels. We also have an Ask Me Anything thread where everybody can ask me anything they want, and I will answer the question the best I can, no matter what. It's less than 20 bucks a month if you go for the annual membership, everybody, and it's the best way to follow my work and my trades in real time, and the best way to support me if that's something you want to do. Now, this is an example of a chart that I shared today, again, tracking that smart money and dumb money divergence. And again, this signal alerted us to re-enter a long position on the S&P 500 today. The details of that position will be in my trades channel. Another chart with a massive buy signal that I shared in the trading community was this. I did not show this in the video. Again, guys, I simply do not have enough time to share everything that I do in the YouTube videos. So again, guys, if you want to follow all of my technical analysis and my economic analysis, as well as my trading, this is the best place to be. I just want to read this very quickly. We've closed above the 50-week moving average on this ratio for the first time since the beginning of the bear market. Notice the beginning of the bear market. The last time this happened was after the bout of volatility that we've seen in September to October in 2020. The market rallied like there was no tomorrow after that. So again, guys, check out the link in the description to join us if that's something you want to do. We could still see one last leg of selling, again, completing that divergence where the HYG perhaps sells off, makes another higher low, and the S&P 500 makes one more lower low, completing that divergence, and then we begin to rally off of that divergence on Friday and into next week. So we have the 50% retracement level, we have the 200 weekly moving average, we have a double bottom with a higher low on the PPO, so a bullish divergence, and then we have the smart money and dumb money bullish divergence. Those are 4 bullish signals This is the fifth. We have the VIX. Look at this, everybody. The VIX made a new high today, closing above Hell's Gate. Remember, everybody, this red line is Hell's Gate. We haven't closed above it so far year to date. This was the first time that we've closed above it, indicating that we're inching so much closer to that capitulation bottom. And I'd like to quickly point out a bunch of divergences here. We have a lower high on the PPO, a higher high on the price action on the VIX, again indicating volatility exhaustion. The last time we had that was back here in the May bottom, and then we had another one right here in the March bottom. The market proceeded to rally on both occasions. In fact, let me add the S&P 500 on here to show you guys what I'm talking about. Look at this, everybody. Following this top in the VIX, we had this rally in the S&P. Again, following this top in the VIX, we had this rally. And again, following this top, we are likely to see a relief rally. Let's take a look at the dollar index. Again, the dollar index continues to weaken. We have failed to go back to revisit this high. We are now squarely in bearish momentum. The PPO is pointing down. It is now retesting, and it looks like it is failing. Let's take a look at the 10-year yield. The 10-year yield is a much clearer chart. We have a double top with a bearish divergence, lower low on the PPO, lower high on the PPO, and we're now seeing exhaustion signals, topping signals in the 10-year yield. And whenever the 10-year yield tops, the S&P 500 rallies. Again, let's take a look at gold, everybody. This is the gold divided by the S&P 500 up top, and down below is the S&P 500. This is, again, a risk-on, risk-off ratio, and I'm still waiting for that bearish crossover on this ratio, indicating that smart money is leaving safe haven assets and going into risk assets like the S&P 500. The last time we had a bearish crossover, we had a rally in the S&P. The prior time, we also had a beautiful rally in the S&P 500. And so we are inching our way closer and closer to that crossover. Now I want to point out the $1 million chart. Look at this, everybody. Up top is the breadth indicator for the S&P 500. S&P 500 stocks above their 200-day moving average, and down below is the SPY ETF, the S&P 500 ETF. And again, look at this, everybody. Lower low on the S&P 500 ETF and a significantly higher low in breadth, indicating that the market internals are improving rapidly. The last time we had that, everybody, was back here in 2016. And what do you know? What happened after we made a lower low on the S&P and a higher low on the breadth indicator? The market rallied massively and the bottom was in. So again, everybody, we have the S&P 500, 50% retracement level on the SPX. We have the 200 weekly moving average. We have the HYG smart money and dumb money bullish divergence. We have the S&P 500 momentum bullish divergence. We have the VIX topping. We have the 10-year yield topping. We have the dollar slowing down. We have the gold to S&P 500 ratio slowing down, approaching a bearish crossover. And we have the most important indicator of all, the breadth indicator, indicating a market bottom. And finally, we have seasonality, indicating that yes, October, we will likely see the bottom for the year. We've either seen it now or we're going to see it in the back half of October in that final crash, final dump, where we will either make a new low, we will retest the low, or we will simply begin to establish a new uptrend with a higher low. Now let's jump into the fear and greed, everybody, and look at this extreme fear sitting at 18. Market momentum is slowing down, but we're starting to see bullish divergences. The put to call ratio is moving back up, potentially making a head and shoulder stop. Market volatility made a new high today, but a lower high on the PPO. Safe haven demand is slowing down and junk bond demand is rising. Finally, everybody, tomorrow we'll have our CPI, the dreaded CPI inflation report at 8:30 a.m. And again, we are 1% away from that 50% retracement level at $352.50. We could simply see that getting tagged in the pre-market, where the market opens down and begins to rally, or we could simply touch it and form a nice doji candle, something that looks like this, where we complete one new low on the S&P 500, one higher low on the HYG, and confirming this bullish divergence and the establishment of a new uptrend. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one, you legends. Bye-bye.
Oh, wow.